It is my firm belief that I'm a risk manager first and a trader only when my duties as a risk manager have been fulfilled. If you are not fulfilling that job for your own trading, no one else will. If price hits a point in which I want to take action, I am going to take action regardless of volume at the moment. Understanding the environment that you're trading in is completely unique to how you trade. I think it's a very important thing to understand that the trading environment has an enormous impact on your results and needs to be monitored. You have to have larger average winners than your average losers. And the only thing you can control, particularly when the environment is not conducive to your style, is the size of your losers. I think whatever your chosen strategy, understand what the ingredients are that make that strategy work. And when they're gone, you have to know that it has changed.
All right. Welcome back, everybody, to our next presenter. We're really excited to have Matt Petrallia of Trading Equilibrium, a very experienced trader of over 20 years. I really appreciate how he teaches and educates about the stock market and trading, a very even-keeled approach. And he said he's going to talk about the unsexy parts of trading today, but I think they're the most important. I'm really looking forward to this presentation, Matt. So thanks so much for being a part of this and being a speaker this year.
Thanks, Richard, for having me. It's really an honor to be part of this lineup. It's a very impressive crew of people that I admire, and I appreciate you offering the invite here, and I'm happy to speak. I love talking about trading, so happy to be here. And I really want to discuss something, as Richard alluded to, that is, doesn't get a lot of airtime. It's not the sexiest topic that's out there, but to me, probably second only to risk management is understanding the trading environment that you're dealing with. And this it's something that applies to every single strategy. So there are different environments that are favorable to different strategies and different environments that are unfavorable to different strategies. So before I get into the nuts and bolts of how I view the importance of trading environment and how important it is to understand it, I need to provide a little bit of background about what I do, right? So I'm going to talk a little bit about really broad strokes in terms of what I do, how I engage the market, et cetera. And then I'm going to get into the trading environment itself. And by the way, the little thumbnail that you have of me, I think I'm wearing this exact same shirt. I'm not sure, but I promise you it has been laundered. All right. So who am I? And I don't mean this in an existential way. Who am I in terms of how I interact with the market? What do I do? What is it that I'm looking for in the market? How do I see the market? So I'm a self-taught discretionary swing and position trader with just about 25 years of experience, all of which is trading my own account. Do not have a Wall Street pedigree. I've never worked for big trading firms, and I've always only traded my own money. And the reason discretionary is all caps here is just because I always like to bring up the idea that I think there's a lot of confusion out there, especially with newer traders, maybe intermediate traders, that the discretionary aspect of trading is incredibly important. And I think that's something to absolutely highlight, because nothing that I do is 100% algorithmic. I am not trading an algorithmic system, right? And if you're somebody that wants to have an if X then Y for every single decision that you make, system trading is your thing. I am a discretionary trader, so I have a rigid process and a foundation, a basic spine, I call it, of my trading process. But there is a good amount of discretion that comes into play here. And one of those discretionary things is understanding the trading environment that I'm in. So I believe strength begets strength. I'm not afraid to buy high, sell higher. Momentum is something that I definitely look for. I'm always looking for relative strength and strong trends. Those are kind of the key underpinnings of how I trade. I do trade both long and short. And I say that because there are going to be moments in this video where I'm sure people are going to say, well, if the environment's bad, why don't you just go short? Meaning if you're not getting traction to the long side, why don't you go short? And what I'm going to try to explain is sometimes there is a poor environment for both. So it's not the answer just to flip short, right? But when I do just notably trade to the short side, it's only swings. I'm never taking position trades to the short side. And that's something I can get into a little bit as well. So overall, I'm a top-down analysis kind of person. I like to generally find the strongest sectors, strongest industries, strongest stocks. Many of you understand this approach very well. And I always try to enter on consolidation patterns, offering the key to everything, which is asymmetric risk-reward opportunities. And that's what I view as the main The main function of charts for me as a tool is to identify asymmetric risk reward opportunities. It's not to be a crystal ball that predicts what's going to happen or tells me what's going to happen. The charts for me, and I'm a very visual person, I used to be an architect, that's why I key on them, is a way to identify asymmetric risk reward opportunities and manage that risk even more importantly. So just again, broad strokes of who I am. And I'm a risk manager first. Those of you that follow me on Twitter have probably maybe too many times heard me say this, but it is my firm belief that I'm a risk manager first and a trader only when my duties as a risk manager have been fulfilled. If you are not fulfilling that job for your own trading, no one else will. And I view basically everything in terms of how I interact with the market through a risk management lens. And it's much more than just where am I putting stops, things like that. It's an entire risk management lens that I view everything through. And I think that risk management has to be number one in that hierarchy. And over the years, over those 25 years, there sure were 5 or 6 of those years that were not pretty. But over the years, I have simplified and simplified and simplified to the point where I firmly believe that you will just lose every single argument you have with price, meaning, the Brian Shannon, only price pays. Many people that say focus on price. I firmly believe that if you are looking at a candlestick or a bar, whatever your chosen method of daily charting is, and you're arguing with that candle, saying things like, well, this is not supposed to happen. This makes no sense. This should have gone lower. You're going to lose that argument every single time, 100% of the time. So as the years have gone by and I've done everything wrong to begin with, I have come down to firmly conclude that following price is my job. I think it's interesting that I am a CMT who really just about shuns every indicator and oscillator for the most part. I have a very small technical toolbox. I'm about to get into that. But while I believe that there is a tremendous value to the technicals, I think really honing in on what works for you is the best methodology. And having studied so many of these different indicators, by the way, most of them, almost all of them, are just based on price movement. So, sometimes just cut out the middleman and go to the source, which is price. But having studied so many of these things, I really do believe that you can certainly have a system tailored to a certain oscillator, a certain indicator, and people have found a lot of success doing that. But if you start to have 8, 9, 10, 12 of those things, it becomes just super counterproductive and a tremendous amount of noise. So I am somebody who has studied all this, got the CMT, all of that fun stuff. And I am still, it even more so made me simplify things. Going through that process made me even realize the decision to simplify is what works for me. So what am I passionate about? I think this is the question. It's not just in here as fluff. I think it's a question that everybody should really ask themselves that's engaged in the market. And if your answer honestly is just money, it's going to be a tough road, right? That's an editorial comment. But I am genuinely fascinated by the market and the process of trading, the process of it, right? The gains that make over the years is kind of like the icing on the cake. And of course, that's a goal, but the process of trading genuinely fascinates me because it's so uniquely personal. And there are so many different ways to tweak your process, to tweak your system, to tweak the way you interact with the market, really tweaking your logic that suits your own personality. I just find it incredibly fascinating. There is no one set rule book, right? And the fact also is that it's very accessible. Granted, we have to be the fortunate people on this earth that have internet access and the funds with which to participate, but it is so extremely accessible at this point in time. It's never been this accessible. All of Richard's amazing interviews on YouTube, all the stuff that the TraderLion guys do. I mean, none of this was in existence before. It was certainly not when I was beginning trading. So there's just a plethora of opportunities to learn and access the market now, which I think is just incredible. But finally, I think the never-ending learning process is what keeps reinvigorating me. So I'm sure we've all been in jobs or some endeavor that starts to become very, very tedious and boring. Trading just never feels that way to me because it is a constant learning process. It's certainly frustrating, can certainly be frustrating, and can wear on your nerves and your confidence. But the constant learning, the constant source of finding something new about yourself and the market reinvigorates me. And secondly, which is the reason why I'm really here and chose this topic, is because I'm also really passionate about shedding light on the realities of trading versus the bright lights, the kind of slot machine noise that can be so frequent, especially on FinTwit. I am actually very passionate about presenting the less sexy aspects of the business that really lead to longevity, because that's the way I developed. I was never exposed to, some of the aspects of FinTwit when I was 24, 25, that were the get rich quick schemes. To me, this was always a long road. And that's where I found the best answers in regards to how I interact with the market, is by looking at that very long road. So some of these very less than sexy ideas like risk management and talking about the environment are the things that I think are actually the most important things. So I'm always a big fan of reality over fantasy, is something that I say quite a bit. Now, just to kind of round out the broad stroke intro here, I'm always looking for signal versus noise. This is always something that, is part of that simplicity approach. And I'm looking for simplicity not only in an analysis type of environment, but also in my decision making. So there's a big difference, right? You can look at a simple chart, but I also want to have a very simple decision making process too. And I strongly believe, through experience learning this, that complexity is a killer. I have been the analysis paralysis guy. I have been the conflicting signals guy. I have been the one that cannot make a decision and then tries to go back and look at a chart and say, well, if I could figure out if that fourth oscillator was doing so and so, then I'd crack the code. And I want simplicity in my decision making, and simplicity in my process, right? So the technical toolbox that I have is pretty small, and the main one is price above everything else. If you told me, I think it's pretty obvious, but if you told me I could only have one thing on a chart, it would obviously be price. What else are you going to go on, right? Distant second and third. I'm not even close, really. Volume and SMAs. And yes, that may rub some people the wrong way. I definitely use volume, but it is still a distant second. I would call it, for me, price is the arbiter. If price hits a point in which I want to take action, I'm going to take action regardless of volume at the moment. And even more distant than that, I use field position, basically ways of distinguishing field position using RSI, which is largely a momentum indicator, and Bollinger Bands, which is standard deviations on a given SMA, generally the 20-day SMA. And I'm going to go into a chart in a second. But price is always my signal. Everything else is simply confirming or not confirming price movement. And I try to keep it very, very simple. So price is always the signal that I use to enter or exit, participate or not participate, etc. So I think we've all seen a chart like this, and I did blatantly copy this from somebody's site who is, I think he's got a site about Forex trading, and he labeled this indicator madness. So I think he was going for the exact same thing that I'm trying to illustrate, because I don't think this was actually somebody's chart, but it does such a good job of it. I just literally Googled cluttered stock charts, and this one was the best one. I think this guy on Twitter is @GhostWireTrader. So giving credit to that person. I thought this was just a really good representation of when you lose the signal to the noise, right? Like I said, this is an exaggeration. It's kind of hyperbolic, but I think we've all seen charts that come pretty close to this, right? And this is where you can start to put that CMT hat on, or your, Nostradamus hat on, thinking that you're going to crack a code. And in reality, what you're really doing is just smothering any signal that could possibly be trying to make its way into your brain and your decision-making process. And what I want to do is peel all this back. And when I started off, maybe not as bad as this, but pretty close. You would look at some of the charts I started off with, and you would say, what is this guy actually keying on? And the reality is, I didn't really know what I was keying on, right? And that was the whole process for a number of years, quite honestly, because back then there was just not the information out there. So I got my intro into the stock market through technical analysis books, really kind of deep, advanced technical analysis books that you really actually become the fundamentals of getting your CMT. So you start thinking that there is a code there somewhere, and that you just keep learning about these indicators, and it's going to finally click, and you end up with a chart that looks like this. 25 years later, didn't quite take 25 years, but eventually, several years later, I end up with charts that just look like this. And I'm not showing you this because of what Google recently did. I'm not talking about, a pivot or a breakout or anything like that. This is just the way I look at my technical toolbox. Price is first. So you can see I just use candlestick charting. In the distant second is always volume. So I'm always watching volume, and I've got an average 20-day volume blue line there as well. And then I have the key SMAs, which for me, I don't even do exponential. Honestly, I just stick with the key simple moving averages. I actually don't want them to be fast, but that's a whole separate topic. And I've got the 9, the 20, the 50, and the 200-day there. And then even more in the distance, and you can tell by the really kind of transparency of the Bollinger Bands in the background there, that's just for field position. So that's keying on, that's 2 standard deviations from that blue simple moving average, which is the 20-day moving average. And that just gives me an idea for, field position in terms of how far a move has run, how much more you could possibly expect. I generally just find that graphic illustration to be a decent way of understanding maybe how much is left in the tank or not. And then RSI, I will use only for divergences, and it's not a signal. I will just use it as a means of, maybe taking my foot off the gas a little bit. If I start to see a big divergence, maybe take some partials, but it's not a signal to go short or long for me. And I bring this up just so that you have an idea of how I trade, because understanding the environment that you're trading in is completely unique to how you trade. And I'm going to get into that in a minute, but I would be remiss if I didn't take a few minutes here to give a very, very broad overview of how I look at the market and how I trade. So I'm always looking for strength, momentum. I'm looking for follow through. I'm looking for trends, and I'm using very, very simple technical analysis to enter in asymmetric risk reward opportunities. That's probably about as nutshell as I can make my trading style in a short presentation. Now, so trading environment, why did I even choose this as a topic? Why is it important? And I think it's important because I think it's very neglected. And I think people, especially in the beginning, but really I've come across traders that have several years of experience and still are not giving the environment the attention that it should be given, in my view. So I think it's a very important thing to understand that the trading environment has an enormous impact on your results and needs to be monitored and understood more so even than monitored necessarily. So a lot of beginning and intermediate traders, I think they focus almost exclusively on setups or possibly indicators. But I think setups are the top of the list for them, because I think there is, this kind of rush to understand, how these setups work. How can I enter? How can I tactically use these setups? And if I can just keep finding these setups over and over again, that's obviously going to be what runs my trading career. And you definitely need to know some setups, but they do not overpower the trading environment. You're not trading in a vacuum. And I think that this kind of instinct to first look at setups more than anything else, I would call it label trading. I've heard other people use that. I've heard Gil Morales use that idea. I'm not at all claiming that I've created the concept of label trading. I think it's a really good concept, though, and that is that if somebody identifies a descending wedge, if somebody identifies a high type flag, a cup and handle, what have you, I think the instinct for newer traders is to not understand that they're spotting a low risk entry or a good risk reward entry, but think that this means this will happen. And that's label trading. So I have identified this. I have labeled this as a cup and handle. Therefore, this means the stock is going to XYZ level. And I think that gets very dangerous and very confusing. And then people start to get very frustrated when those patterns don't work out that way, which, for the most part, at best, you're going to have patterns that work maybe 60%, 70% of the time. So the belief, I think, is that the right answer can be found if you can simply label these patterns or use an indicator, et cetera. And I think even more hazardous is this belief that traders, if you want to call yourself a trader, it means you should be making outsized returns under any conditions. Bear market, kill it. Choppy market, kill it. Bull market, obviously kill it. I think that's something that people really get hung up on. And it can take quite a while to understand that that's not the way that things work. And it's because the environment is constantly changing. So I think there's an initial assumption that your process actually equals spot setup, then execute. And that's basically the nuts and bolts of the process. And you're missing a very, very key ingredient of understanding the environment in which you're operating. And if that is your kind of basic understanding, I think it really leads to boom and bust trading, in that people will just repeatedly take these setups over and over and over and over again and just wonder why, hey, suddenly they're not working. Why is this breakout suddenly not working? It was working great in 2022. To make the obvious analogy, bring it back to real life. The things that worked in 2022 have not been working since, 2020 have not been working since 2020. I mean, there could not be a clearer example than what we saw happen in 2020, and then completely different environment, basically since February of 2021. And then in 2022, we obviously had what I think we can all agree was a pretty nasty bear market, long duration bear market. And the environment is going to change the way your setups, the outcome of your setups. More than anything that you're doing, the environment is changing that, right? So the boom and bust trading happens when people just think, oh, all I have to do is spot a clear horizontal pivot level and the breakouts are going to, I'm going to be fabulously wealthy by doing that. And that may have worked in 2020 and then it no longer works, right? So in the best of circumstances, you're going to get a boom and bust trader. I'm greatly oversimplifying this, obviously, but under the worst of circumstances, it's going to lead to ruin. So understanding the environment, extremely important. And it's also, I think it's, just keying on what I mentioned before, the market is not an ATM. Every strategy does not work every single day in every different kind of trading environment. I'm going to talk about account feedback later on, and it's actually one of the most important ideas here, but it requires a consistent trading logic. But that is one of the best ways in which to identify the optimal environment for your strategy. But a lot of traders are not at the point yet where they have a consistent trading logic. And I'm going to get to this a little bit later, but you must understand, especially if you're not at the point where your trading has become very, very consistent, then understanding the environment is even more critical because your account feedback is going to be largely as random as the randomness of the trading that you're undertaking. So employing your strategy in an unfavorable environment will lead to some very bad things as a trader, which is not just financial losses, but really a major loss of confidence, which I think can be very deleterious to somebody who is trying to actually treat their trading like a business. A confidence gas tank is something we all want to keep pretty full. And constantly beating your head against the wall in an unfavorable environment is a very, very quick way to deplete that confidence. It's simply using the wrong tool for the job. And I think a lot of people will take it personally and think, I am doing something wrong. There's something that I'm missing here. There must be some secret thing here to execute this strategy so that it works better. I must be doing something wrong. When the truth is you're using the wrong tool for the job. You're throwing a football to first base. You're watering the lawn with a drinking cup. Whatever silly analogy I can possibly come up with, you're just simply using the wrong tool for the job when you're trading your strategy in an environment that is not conducive to that strategy. So what is environmental awareness? It's understanding that the best textbook setups for your strategy will fail more regularly in an environment that's not conducive to your strategy. It's simply understanding that the environment trumps your setups. You will certainly in 2020, or excuse me, 2022, I'm getting my years mixed up. I just turned 50, so time is going by. But if you have setups that worked in 2020 and then they do not work, just like I mentioned before, and you're asking yourself, why are these textbook setups not working? In 2021, we still have some textbook setups that would have worked in 2020, and they're just simply they're not working now. So why is that? Is it because I need to go take a course? Do I need to watch 49,000 YouTube videos? What's the secret I'm missing? The environment is not right for your setups, right? And that's something that we need to all understand. So instead of myopically focusing on setups as if we're trading in a vacuum and all that matters is the setup, I firmly believe that we need to understand that we need to understand the environment that suits our style best. So for me, why I went through that little blurb in the beginning of how I look at the market, it's going to be different for everybody. And I can understand pretty easily what the characteristics are of a poor environment for my trading, as well as a conducive environment for my trading. And it's going to be different than for a day trader. In fact, sometimes they're the complete opposite characteristics. So you may be a day trader, you may be a swing trader, position trader, buy and hold, investor. You need to understand ask yourself, what are the ingredients that make my strategy successful? Maybe for a day trader, it's really wide range days. Maybe they like the volatility, right? For me, that's what I don't like, right? But you have to, I think, whatever your chosen strategy, understand what the ingredients are that make that strategy work. And when they're gone, you have to know that it has changed. So, and when I talk about an environment, it's not a label, just like with setups. I'm not labeling the environment bullish or bearish. You can, in fact, have a stance that is not bullish or bearish and one that just simply tries to understand if your style is working. And I was able to make some gains in 2022 on the short side. Go figure. It was a bear market. But then there have been some times where I felt, very challenged with my style because both long and short were not working. And that has nothing to do with a bull market or a bear market. It has to do with the ingredients I need being missing, and I'm going to get into that. So have you ever wondered why you're doing the same things you've done before and getting different results? And there's the famous Einstein quote that insanity is doing the same thing over and over and expecting different results, and that is brilliant. But that also applies, I would argue, to the physical world where there are physical laws. There's yes and no answers. The market is not that. I would argue that in the market, it's insane to do the same thing over and over again and expect the same results, because it's not going to happen. The environment matters, the environment changes, and it's going to change our results. We cannot take the same actions day to day, every day, and get the same results. Even those people that do rigorous back testing, with highly developed and tested data over a course of decades, actually back testing that find systems that work, those systems will suddenly stop working. Because the environment changes and nothing works in every environment. Again, we are not trading in a vacuum. So I also want to mention the illusion of control bias, because I think this plays a lot into how people are understanding the environment changing or not understanding the environment changing. So the illusion of control bias is basically the fact that we tend to think we have much more agency in outcomes than we really do. In 2020, everybody was a brilliant trader. Everybody should quit their jobs and make money hand over fist every day. In 2022, everybody doesn't know how to trade. Everybody goes back to work. Nobody knows what they're doing. When the reality is that the environment has simply changed and people were not responding or acknowledging, I should say, that the environment has changed. Therefore, what they were doing before is not working. And it's much less due to their agency than the outside force of the environment changing. So when we're making progress, like in a 2020 environment and stringing together gains, it's much less due to our genius than it is due to the market conditions being favorable for our strategy. Yes, some traders are better than others. Yes, some traders have better instincts, better ways of executing things than others. I guess I shouldn't say better ways of executing, but more experience and a firmer understanding of what they're doing, which comes with experience. And when we're getting chopped up, through, I would think most people on this stream right now have had some experience getting chopped up in the past 15 months. And you start to question, am I actually a trader? Like, what am I doing here? And that is much less due to us being incompetent or not knowing what we're doing than it is due to the market conditions being unfavorable for our strategy. And yes, you can exacerbate all of that by doing some poor risk management and the like. But in general, the meat of the issue when you're getting chopped up in if you're a consistent trader, is the environment has changed. So in that last example of getting chopped up, what we're really guilty of is not understanding the environment that we're operating. We're not guilty of being incompetent or miserable traders that should never have entered the business. We are not understanding the environment which we're operating and making the necessary changes. So like I mentioned earlier, we need to understand the optimal ingredients required for our specific style, and that will be different for every style. So I'm just going to only talk to what I see for my style, and that's why I mentioned this in the beginning. And somebody who has a completely different style will have different ingredients, because the market will there's always going to be a style that works. There's always going to be a style that doesn't work in a certain environment, but no single style works in every environment. So you need to, I really recommend that everybody do this simple exercise of thinking about what are the ingredients needed? What's the recipe needed for your style to flourish? Really think about it. Instead of thinking about setups and charts and moving averages, really think about what are the ingredients that make swing trading work successfully. And you want to monitor those if those ingredients are present and if they're changing. So for my style of swing and position trading, the key ingredients include some simple things. I need follow through. I need momentum, particularly for swings. If anytime you're holding a position overnight, you need follow through and momentum. It's just the definitional kind of expectancy that you have for a swing trade. If you don't have that, you're never going to get swings. You're never going to get price to move in the direction that you are anticipating, or any kind of overnight follow through whatsoever. And we've seen a ton of that recently where we don't have follow through. We don't have momentum. It's recently started to change. I'm not going to get into all that, but to bring it back down to earth, it has recently started to change. And it's refreshing, I think, especially actually some of the action we saw on Friday. And I may touch on that a little bit, but without follow through, without momentum, Swing trading doesn't work for me, right? And then for position trades, it's even more clear, really. I need a trend. If you're going to be in a position trade for months, maybe even more than a year, if you don't have a trend, you are absolutely employing the wrong strategy, right? So you need a clear trend. If those two things are not there, it's going to be a much tougher environment for me to swing trade and position trade. And it can be as simple as that. And like I said, if you're a day trader, what are the ingredients? Depending on your style, you want intraday volatility. You want wider ranges. You want some reversals that you can exploit. You want the volatility to ramp up. You don't necessarily care about longer term trends. So I just encourage everybody to literally make a list of what are the ingredients that you need to be successful at your strategy, or for your strategy to be aided by the environment. So what are the characteristics of a poor trading environment for me? Swing trading and position trading. Frequent 1% overnight moves. This doesn't have to be a gap in both directions. Higher, lower, both directions, meaning up 1% or down 1%. Again, does not necessarily need to be a gap. Just means the market closes. And I'm going to use the indices as an example, but it applies to individual stocks as well. But on the SPY in 2022, how many times did we see an overnight move that opened 1% higher or 1% lower? I was calling it the amnesia market because you woke up and nobody cared what happened yesterday. It was going to open higher or lower. There was no rhyme or reason. There was no follow through, which is that thing that I need, right? High volatility, frequent 1% plus intraday reversals. We had some of those days like CPI days and FOMC days where there were 6 or 7 of those at a time, right? It looked like an EKG chart, but it wasn't just on those days either. We had high volatility, frequent intraday reversals. And I don't just mean on the indices, but on, the underlying too, which obviously gets reflected in the indices. And this apply, these are things that perhaps are things you want to see as a day trader, but it's not what I want to see. And then I think even more kind of easy to identify is a weak or ambiguous midterm trend structure. And by that, I just mean the simple thing that we can all graphically see as in higher highs, higher lows, or lower lows and lower highs, right? It's a simple trend structure as you learned from day one, we get lack of follow through in both directions as a result. And then finally, a news-driven market is it's a little bit like the tail wagging the dog, because with the news-driven market, you're frequently going to get all three of those things above. And all three of those things above are usually going to result from the news-driven market. So we've had all of that through all of 2022. So it's no surprise. It's no surprise that is a very tough environment to do swing trading and position trading. And I put a note here mainly for me to say that you shouldn't gloss over this with just stay out of a bear market, because I'm not one of those people that thinks, all right, I'm just taking off. I mean, I respect that. But there are ways of using your strategy, understanding that it's a difficult environment. And I think that, the first step here is identifying what are the ingredients of the strategy that will provide the tailwind. What are the ingredients of the environment that will provide the tailwind to your strategy? And then you have to make tactical decisions. And I'm going to get into that right now, but it is not simply a case of stay out of a bear market. I'm not saying that because, I could just anticipate people saying, well, go short or just don't do anything, right? And I actually do trade short. So I'm trying to make the point that sometimes the environment is simply a major headwind for your strategy, even if you are going both long and short. So just to do a little bit, I know I've been throwing a lot of bullet points at you. This hasn't been the most graphically exciting, especially from somebody that was an architect, but here is a chart. And so this is just simply illustrating the second to last point I made, weak or ambiguous midterm market structure. Can you see my cursor actually? Yes. Okay. So green line, 50-day moving average. I think we could all agree that's pretty much midterm trend indicator. This is, good luck figuring out where that's going, right? This is going sideways. This is an entire period where the S&P 500 was largely going sideways. And this is what I would call weak to ambiguous midterm market structure. We had a low here, we had another high there, took out the low here. It's changing, right? We could certainly obviously make a case that it is or has changed, but in this area, we've got a lot of chop. We've got a tremendous amount of chop, and this is a year's worth of chop, right? So you see the 20-day moving average all over the place, right? So I would define this as just a simple graphic way of trying to illustrate what I'm saying, where you have weak to midterm market structure. It's pretty easy to see in this area that began with 2022. big, strong downtrend, right? It starts to become less clear. And this is why I'm also saying you don't want to just call it bull or bear. This is an environment. This is a trading environment. Who cares? Bull, bear labels, doesn't matter. This is what you're engaging in when you're trading. And this is a weak to ambiguous midterm market structure, I would call it. Another kind of graphic way to represent this. And again, I will wrap this up eventually by saying that account feedback is your best tool to understand this, but there are some ways to see what I'm talking about. And this is ATR, average true range, which is a volatility measure. Basically what it's measuring is expanding ranges. The look back is usually 14 days, but you can see here this is SPY again. We've got this general range with climaxes right around, let's say 6.2, 6.3. I don't know exactly what it is on this chart of average true range expanding in this firm uptrend. And then we start to see average true range really explode. And that is what I'm talking about in terms of a poor trading environment for swing trades. This is a way to, a lot of what I'm saying, most of what I'm saying is qualitative, but this is a quantitative way to kind of see what I'm talking about, where the range expansion really happened here. Lots of gaps. This is where lots of those 1% up, 1% down moves were happening. Really difficult, right? And this is also, if you know anything about average true range, if this was a $30 stock or something like that, the average true range number would be much lower because it's based on the range that's moving, right? But if you'll note this, price is moving lower while the average true range is moving higher. So it's even making up for that dynamic. And then here, as we finally start to make a little bit more of a noticeable structural trend in the midterm time frame, we see average true range start coming back down. So this is an ingredient that I'm finding actually hopeful recently and encouraging, because average true range has started to come down. We've had less of those days. I'm sure you've all felt it. We've had less of those 1% move days. We've had less of those massive gaps, or we've had less of the amnesia market, I guess is what I would call it. And then you say, well, why don't you just use the VIX? You can just use the VIX, right? But I just think that ATR, it really shows the actual expansion of the range much more. So the VIX just kind of hit its head up against these levels here that were really basically the same as kind of any old textbook pullback in 2020, or early 2021. And then you get the same kind of level spike here, even during the bear market, which I think a lot of people were confounded that the VIX never made this huge spike, right? But I think more informative, at least looking back, is that the range was expanding. And that's the point I'm trying to make here, is that this environment, and I'm not going to call it a bear market, even though obviously we could. I'm going to call it a trading environment that was not conducive to swing and position trading, right? And I would argue through my own personal experience, actually, that earlier on in 2022, when there was a pretty clear, strong downtrend, you could participate on the short side relatively successfully. And as time wore on, it became less so, from my view, from what I do. Because this range expansion environment, this high ATR environment, this weak to ambiguous midterm structure environment was the environment I was interacting with. So what's evidence of a poor trading environment? I told Richard this was going to be 45 minutes, and I'm already probably going long. I'm going to go faster. What is the evidence of a poor trading environment? Most stocks, not just the SPY and the Qs, and by the way, I could do that ATR example with the Qs as well. But most stocks become noisy. They're trendless, listless, range bound. They don't have that follow through ingredient. Increased intraday volatility with frequent reversals. A lot of individual names start ignoring some key levels that you would expect them to respect. I think we saw a lot of levels absolutely become very volatile levels instead of being respected as support and resistance. A lot of pivots with the same type of thing, trend lines, same type of thing. A lot of names moving up and down through MAs like they didn't exist at all. A lot of just noise, a lot of price noise. And I think we saw a lot of that in 2022, especially towards the end of the year. And again, very little follow through either to the upside or the downside, which is what makes a poor swing trading environment. If there's a lot of follow through to the downside, I can get behind that. I can take some swings to this short side. When there's equal chop in each direction, very, very difficult. And that's when those people that say, well, why don't you just go short? They're missing the concept that sometimes the environment is just not conducive to swing trading in either direction. And you have to be aware of that. So in the opposite direction, and it's not all about just playing defense, but understanding all of this is what will allow you, I believe, to play offense more effectively. So what are the characteristics of an optimal trading environment? Just the opposite. The things that you need for swing and position trading: clear, strong structural trend, higher lows, higher highs, or the inverse. Low volatility, where we have, we just saw the VIX collapse over the past few days, which I find a bit encouraging. I think it's down to 15. It had been trading, it had been in a range of 17 to 21-ish for quite a while, and it did just recently collapse. And you saw ATR coming out of the SPY. I find those things encouraging. So lower volatility. We will start to have more frequent trend days, where the market opens. Maybe it opens where it actually closed last night. God forbid that should actually happen again, right? And then it actually trends higher throughout the day, and that becomes a much more conducive environment for me to swing trade and position trade. And in general, you'll see stocks that are supported in pullbacks and higher volume on follow through. And volume does become, my high priority on the as the second indicator that I'm looking at next to price. When you start to see higher volume on follow through, so when you start to see these things, when you can understand the poor environment, then you can obviously understand the good environment. And this is when you want to start getting aggressive. So you've got three choices when you finally understand and are paying attention to your environment. And it is by no means something you need to get a PhD in, right? But you need to pay attention to it. But you have three choices when confronted with a poor trading environment. One is change your style, change your strategy, right? I'm going to become a day trader. I'm going to compress my time frame. I'm going to become a day trader. Everything is out of whack for swing trading, so I'm just going to day trade. You can go for it. You can do that. Personally, I find that changing lanes like that for me is incredibly unsuccessful. And I find that in general, very, very talented traders usually have a specific lane that they excel in. There are definitely people that can excel at day trading, swing trading, position trading, but I think it's very, very difficult, right? So you can do the change your style strategy drift. I don't encourage it. I do not do it. Two, employ defensive tactics that help you adapt to that different environment. And we always hear about adaptation. And for me, adaptation doesn't mean become a day trader. It means change my tactics a bit, right? And I'm going to go into that very quickly. But my main goal is still conserving capital. That's why there's defensive tactics, both mental and financial, until conditions improve. Your third choice, which I think is a good choice either, is disengage, go away completely. There have been moments, and I did it as well, where 2-3 weeks, I'm just not taking trades, period, right? And I am fine with that. And there are times to do that, but I'm not going to just disappear for 15, 18 months. I'm going to employ some defensive tactics and still interact with the market and rely on that feedback to tell me when things may start to be changing. But let's be honest, there's really actually 4 choices. And this is the worst choice, which is keep doing exactly what you're doing, despite the horrendous feedback you've been getting. So keep forcing trades that aren't working. Keep taking those setups that aren't working. Keep sizing in your wheelhouse, whatever your regular size trade is. Keep sizing up. Ignore the environmental changes completely, and just think that it's going to work in the end, and this is what I should be doing. And that's the trader that's focused on the setups in a vacuum and is not paying attention to what the environment is. And unfortunately, I think this is actually not an uncommon choice. And I think people will do this and start blaming themselves and not understanding that the environment is not conducive to their style. And it really deteriorates people's confidence and really empties that confidence gas tank. And I think these little images are exactly what you're doing here. You're banging your head against the wall, and you're not understanding that the environment is not conducive to your style at the moment. So choice number 4, if this has been you, this was definitely me as well. Like I said, I've made every mistake. Every mistake I could come up with, I've made it. So I have been number 4 guy. And you have to realize, this is what makes me realize that one of the most important aspects of trading, second to risk management, is operating in the right environment. So defensive tactics. And I promise I'm going to wrap this up pretty soon. But defensive tactics, when I am looking to still participate in the market, but not be aggressive, and I am expressing the fact that I understand that the environment is not in my favor. Trade less. Number 1, trade less. Decrease the frequency of trades. Narrow my focus list. I want to look at 1 or 2 or 3 names. Get involved in 1, 2, or 3 trades max. For the entirety of 2022 into 2024, I never had more than 4 trades on at a time, and that only happened twice. And I was profitable in 2022, by the way, by grinding just like this, but understanding that the environment had changed. I sized smaller. My usual size is 50 basis points. That's the way I size a trade, is the risk between entry and exit as a percentage of my total account. I would size smaller, 25 basis points of risk, and I would take 1 or 2 trades. I would have 25 basis points in my account open at any given time. I would cut losers mercilessly, and this goes into a question that I get pretty frequently. And this is a means of helping my underlying trading math. And the underlying trading math for every trader, most traders are somewhere in the 30% to 60% batting average range. Sure, you can have higher. Well, you're not really going to have lower, because if you get too much lower than that, you're out of business. But most traders are going to be in the 30 to 60% batting average range. So your simple trading math is pretty obvious. You have to have larger average winners than your average losers. And the only thing you can control, particularly when the environment is not conducive to your style, is the size of your losers. So during 2022, one thing I did was I noticed through looking at my previous trades through a trading journal, instead of reaching an average of 3R, 4R, 5R, I'm hitting 1.5R, 2R maybe on the on these trades. They're not running, right? So that's not the math I need if I'm going to be a 50% trader or lower in a poor market. That's not the math I want. What can I control? I can control my losses. So I cut my losers quickly. That means getting stopped out more. Batting average goes down, but that ratio between winners and losers is what kept me profitable in 2022. Another thing I do is aggressively protect break even. I don't care that it's choking the trade. I'm out of break even. It's a tactic. It's a decision that I make. I'm going to raise stops to break even quickly. It would be absolutely choking off a trade in an optimal environment where you want to give a trade breathing room, but in a very choppy environment that is providing a headwind to me, not a tailwind, I'm protecting break even very aggressively. And finally, I'm taking larger partials, and I'll take them sooner. So usually I take the first partial between 1 and 1.5R. I'll take it at 1R or even sooner, and I'll take larger. Usually my first partial in a good market is a quarter of the position. I'll take a third or even half in a defensive mode. So these are the defensive tactics that I employ. And I encourage everybody to have a list of how do you get defensive tactically when you're in the wrong environment for your strategy. This is how I do it for mine. And keep going. The common question that I get that I just wanted to bring up here, and what I just listed was how do I know when to cut a trade short? And this goes to kind of a perceptual understanding of what you're doing. And for me, it's not a sign. I'm not looking for a sign. It's the decision itself that I made before I entered the trade. The decision itself was that I'm going to cut this trade short. It's not, hey, there's something on the 1 minute chart going on, or I know this is just going to go lower. Or I know this isn't going to bounce when I cut it, because you never know that. Nobody ever knows what a trade is going to do when you exit, ever, period, no matter what, right? So stop trying to know and beating yourself up for not knowing. You can only control your own actions. So my decision here is a tactical decision. I'm going to cut trades short to keep that math intact. What I mentioned before, keep my losers smaller than my winners. So it's a decision I make before I enter the trade. I'm not even remotely going to try to pretend like if I know the stock is going to hit my stop. If it starts moving against me, particularly right away, I cut it. I have been cutting through all of 2022. I cut trades at around -0.2, -0.3R. So quickly. And that has been stopping me out more, no doubt about it. And some of them reverse, some of them go lower. I don't know which is going to happen. But it is a methodical decision that I make beforehand. It's not based on a 1 minute chart. And the bullet point is just kind of emphatically saying that how do I cut trades short? By cutting them short. That is the decision I've already made. The decision has been made ahead of time. All right. So finally, aggressive tactics, which is what, most people want, right? We want to be aggressive in the right environment. And all of this stuff that I've just mentioned is how to be defensive, how to identify a poor environment for my strategy, at least the way that I do it. But then, being aggressive is exactly what you want to do when you can identify that those ingredients are lining up so that you have a tailwind. So I'm going to expand my number of open trades. I'm not going to go crazy because I'm not the kind of trader that has 20 trades on at one time, but I will have 5, 6, 7 even trades on open at one time. I will size up if I'm really gaining traction, 75 basis points, maybe even 100 basis points, and I will use options as a tool. And this is a whole separate talk that I could go into, but it's a way of using leverage in the right environment. So I'm not the kind of trader that is purely an options trader that, that's my be all or end all. I use options. I will use them in the right environment to be aggressive. That's how I will use them. Also as a way of defining risk. And that's a whole separate topic. And I will start avoiding that strangling a trade thing that I was doing with protecting break even. Start disengaging from those defensive tactics. And really honest, if I'm being completely honest, I need to start doing more of that now, I think. Based on the feedback that we've started getting, I've started getting some good feedback. Am I going to pretend like I was 400% long in NVIDIA and AMD and SMCI, and I knew all those moves were about to happen. No, but I did take some good swing trades in some of those names, and actually managed to get my position sizing back up to 50 basis points. And I think that I'm going to start being less defensive, particularly since we saw that breadth expansion on Friday, saw the smalls and mid caps participating, et cetera. And I will start avoiding strangling some trades a little bit more, because I have been, like the Boston Strangler on these things. And I want to give them a little bit more breathing room and let them breathe and behave a little bit better when things are starting to work. And I have already started taking smaller partials and less aggressively. So I have, on recent trades, actually taken partials at 1.5 R and have it be a quarter of the position. So these are all things to get aggressive. I have not started sizing up to 75 basis points or using options yet, or really ramping up my number of open trades, but I'm starting to get to that level where I'm going to feel more comfortable doing that. So you can understand what I'm trying to present here is that I'm employing the same trading style. I didn't become a day trader. I did not become a mean reversion trader. There's a lot of things I did not suddenly become, but I'm using very different tactics based on how I'm seeing the environment behaving and how I'm seeing the environment either providing a tailwind or a headwind. And then progressive exposure obviously is a big part of this and should always be a big part of everything, honestly. Establish a baseline trading size. For me, that's 50 basis points. And this is how you will react defensively or aggressively, right? So this is something probably everybody knows, but I think it fits in here with this idea of understanding environment. So when trades are finally gaining traction and the environment is conducive, size up, right? Just like what I said, when feedback is poor, size smaller. And one thing that I do, which I think tons of traders do, which I think is very helpful, is that when I'm hit with multiple stops, and that's going to happen, especially when I'm doing the defensive tactics, like I said, I just take a break, step back, slow down, and then maybe even size smaller in the next trade. So if you're a 50-50 trader, I think a lot of people don't even understand this simple math. If you're a 50-50 trader, if you have a string, think of it as like flipping a coin. If you have a string of 50 trades, you are absolutely guaranteed to have 4 or 5 in a row that stop you out, that are losing trades. You're just guaranteed. It's mathematically the way that it is. It's like if you are a 50-50 trader, those odds will be even worse for you if you are a 30% trader. You may have 7 or 8, 9 losses in a row pretty frequently, and it can happen, right? The key is keep them very small. And that's why I was talking about when I'm being defensive and I'm having that lower batting average, I'm cutting trades very, very, very quick. So I think this is very important to understand that if you're taking that defensive approach, you're going to have more multiple stop losses in a row hit. Keep them small. That's what I've been doing. And then finally, which really, to me, honestly, is like the entire talk here, is account feedback, but the caveat here is to make your account feedback meaningful, you have to have reached a point where you are consistent. You have a logical consistency in your trading, meaning you don't wake up on Tuesday as a day trader. You don't wake up on Wednesday as a mean reversion trader, and then Thursday as a position trader, and Friday as a breakout trader. You have to be consistent. You have to have established a logical consistency in your trading, because if you are that person who is a different trader from Tuesday to Friday, your feedback from your account is meaningless because you're taking random trades, you're employing random strategies. It doesn't make any sense. If I am a rigorous trader with rigorous logic and discipline, with a certain style, then that feedback makes a ton of sense and is very important to you, because it's literally telling you the environment is not working. Assuming you're not making silly mechanical mistakes or simple trading mistakes that are simple mistakes, right? And I know Jared Trendler was talking about things like that. As long as you're not making those types of silly mistakes, and you're a consistent trader, then this account feedback is absolutely paramount. And you are your own best indicator, honestly, in terms of environment. And you may not even be noticing that the environment has changed, but your account is telling you it has changed. So I think it's incredibly important. Are your last 3 or 4 trades working? I think a lot of people think of this in terms of simply progressive exposure, which it leads to. Like if you have the last 3 or 4 trades working, size up. If you haven't whatsoever, but really what it's telling you is the environment is changing, right? It's not just about the randomness of your trades working. The environment is changing. So very, very, very important. If you're not making execution errors, like I said, and not gaining traction, it's a great sign. Your account feedback is the best sign, I think, that the environment has changed or is simply a poor environment in general. And then in summary, which I'm coming in at 53 minutes, environment is more important than setup. You cannot have it the other way around. The setup does not trump the environment. You're going against the odds. Yes, Did NVIDIA run like crazy in a poor environment? Yes. Did most stocks not? Yes. The environment is going to make your odds decrease if you are trying to fight it by taking setups in a vacuum, right? So environment is super important, and I would put it in the hierarchy definitely above setups, because every single setup has a lower chance of success in an unsuitable environment. And this is a probabilities-based endeavor. I want to stack the odds in my favor. So I am not going to participate aggressively in an environment where I know the setups that are my bread and butter setups have a lower chance of success. It just doesn't make any logical sense, right? So you have to understand first how important the environment is. Then I think it's great for everybody, no matter what your style is, especially if you're a newer trader. Honestly, make a list. What are the key ingredients that you think are necessary for your style to thrive? What are the key environmental ingredients? Now, that doesn't mean I'm not talking about I need range contraction below a pivot line. That's not an environmental ingredient. What is the environment that you need? Do you need big range days? Do you need lower volatility? Do you need follow through? What do you need? I would strongly suggest identifying that and then being vigilant and really consciously aware of when some of those key ingredients are missing, right? So that's something that you can keep an eye on, particularly if you're not at the point where you really trust your account feedback. Be vigilant about when those ingredients are missing and act accordingly, meaning have a defensive plan, have an aggressive plan. Don't be option number 4 person where you're banging your head against the wall every day. Have a defensive tactical plan and an aggressive tactical plan. I also don't recommend style drift being the choice number 1. And then, I'm just going to end it with rely on your account feedback. If you have reached the level where you trust your account feedback, and I'm sure many of you have, that is the most important indicator, I believe, that will give you insight into the environment you're trading and whether or not that environment is conducive to your style. But it does require a consistent trading logic. So thank you. I hope that this one of the least sexy topics out there shed some light on some of the ways I think about the market. And I really do strongly believe that everyone would benefit from making a simple list and firmly understanding what kind of environment suits your style best. So thank you for having me.
Thank you so much. I already saw some comments in the chat saying that this presentation really helped them out and kind of change how they think about things. So thank you so much for putting that together. As I'm asking these first few questions, if anybody watching has questions for Matt, please drop them down below in the live chat. I'll get to those in just a second. To start things off, Matt, I think it'd be good to talk about how you developed this awareness or need to analyze what the environment is like. Where did that kind of start in your personal trading journey, and how did that kind of change how you operated as well as your performance and trading overall?
Yeah, it started too late. But I won't say that because I've recovered. I'm a recovering non-environmental awareness trader, right? But yeah, early on, I was not paying attention to things like this. And the reason I don't feel badly talking about, those people that, are labeled traders and focus on setups only and their process is set up, execute, is because I was that person, right? So I'm not trying to be derogatory in any way. I was that person, right? And then, it's things start to click in different ways for different people. But I think it's when I started to embrace the real idea, and it seems patently obvious, but when I started to embrace the real idea that this is a probabilities-based endeavor, right? And I want to stack probabilities in my favor. And it became extraordinarily clear to me suddenly, hey, one of the probabilities that needs to be in my favor is the overall market environment. What am I trying to accomplish something here that is simply not going to work in this environment? Am I playing baseball in the rain? Simple things like that. And I think once I realized that, it took me several years this was not on my radar when I was starting trading, right? It took several years. I always kind of exaggerate saying that everything took me forever. It did take a while though. It took a while for this to click, to register in my brain that this is a very, very important way to stack the odds in my favor. So several years it took me to focus on this. And it has been something that is a major priority. Risk management first, I would say environmental awareness second, honestly. And then there's a whole host of things that go beyond that. But without the risk management, you're not gonna last. Without the environmental awareness, you really run the risk of eroding your confidence in your financial capital much quicker than you want to, even if you have good risk management.
Yeah, perfect. And I like how you pointed out that um, the characteristics that you look for are suiting your style, what you look for in the market. While there's some amazing traders out there that are more mean reversion focused, that's their strategy. They're going to look for a different set of circumstances than you are because that's the optimal environment for them. Same as you mentioned, intraday traders want that volatility. That's the death for momentum guys who like follow through. So it's really about, as you said, identifying the environment that you operate the best in, where the probabilities are stacked in your favor, and knowing what those characteristics look like. So I think that's a really important point. Um, I want to ask you, what are your specific routines, whether it's on the weekend or every day, that you do to stay on top of the environment and start to look for those characteristics, either that the market's improving and getting more towards your optimal environment, or degrading a little bit and you're starting to see more of those negative characteristics.
Yeah, so it's a mix of certain things, and I'm not one of those people that really thinks you should not be paying attention to indexes. I definitely am. I am paying attention to them every day and every week, and doing simple technical analysis on the indexes. So if there is a weak trend, I'm usually feeling it as I'm trading. So it's a mix for me between that account feedback, which after doing this for a long time, I am confident in my account feedback that when something is when things are just not working. I know it's not suddenly I just don't know how to do anything. I know that there's been a change here. There's been a change, and that alerts me to start looking for what's going on. Or conversely, I start to notice in the environment that something is going on, and inevitably my feedback will go south, right? But it's that mixture of things. I rely heavily on my account feedback, but I am always looking at the indices. I am always looking at the simple trend structure. And I do look at ATR, right? So when things start to get really, really volatile, I like using ATR over VIX, honestly, because of the reasons I showed you, right? But when things start to get really, really volatile in both directions, that is a really good clue that it's time for me to either step back for a little while entirely, or employ the defensive tactics for until that improves, right? And for a very long period here, we've been in that very high volatility environment. What's been encouraging to me recently, aside from the fact that we've seen those shot out of a cannon moves in the like white hot AI names and semis and mega caps. But what's been encouraging recently is that we have had that ATR start to come down. I have started to see individual stocks actually respecting, moving averages and pivots a little bit better, and showing some follow through. Granted, recently it's been those shot out of a cannon names that suddenly showed follow through, like that Google chart I put up in the beginning. That is not your typical 2023 look, right? That actually took off from a horizontal pivot and did not look back and is now consolidating. That's more of like a 2020 look, right? So that's telling me things may be starting to change as well, although in a very narrow section of the market. And what really encouraged me on Friday, just to make it applicable, is that we had that massive breadth expansion, and seeing small caps and mid caps start moving. That actually genuinely got me a little bit excited, even though I'm a very even keel person. But that is what you want to see without having follow through and rotation. None of this is going to suit my style, right? So I think it was a very long-winded answer, but I'm definitely looking at account feedback, and I'm looking at very basic structural trends.
Yeah, perfect. And one other thing that I completely agree on your points, account feedback as well as the indexes, analyzing all of that. One other thing that I personally do, which people watching might find helpful, is I kind of keep a running list of the strongest stocks in the market, the leaders, stocks that are trending above moving averages, performing well, showing momentum, breaking out. If that list is healthy, they're acting well, they continue to trend and perform nicely. That's a sign that the environment is pretty decent. But if those stocks start breaking down, I have to take them off the list. That list starts shrinking. There's more volatility in there. There's a lot of gap downs on volume. That's feedback that for my style, the stock that I'm focused on, those high momentum names that are trending and offering opportunities. If that list is getting smaller of potential trades, I know it's time to take a step back a little bit and use more of the defensive tactics. So that's one more thing, one more tactic that people can employ.
I think breadth is something. I think breadth is something that definitely fits in here. But I would also just, I just would go back to. I don't want to label it bull or bear. I just want it to be the right environment, right? And you can actually have poor breadth and still have a reasonably decent trading environment, depending on what your strategy is, right? But certainly having breadth expand is going to make it much more likely that at least you're going to start trending to the upside. There's no doubt about it. So the recent breadth expansion is encouraging, and we've all been looking at the charts. I mean, I don't even include any of them because they're just, if you've been on Twitter for the past, I don't know, 3 months, you've seen 7 billion breadth charts, right? We all know the divergence in the SPY, 40% of stocks were, below or above their 200-day moving averages, while the SPY was actually making higher highs in price. So we've all seen that divergence, but it's really, the volatility is still coming down even with that divergence, which is what I find interesting.
For sure. And you mentioned journaling a little bit, and obviously keeping track of your recent performers, past 3 or 4 trades. What kind of metrics do you keep track of? Like, for instance, do you keep track of like what your average gain has been over the past 20 trades over the past 2 months to get a sense of, how on average things are working from your entry points? Or what in general would be your recommendations for people to start journaling if they don't do so already?
Yeah, I mean, if you're not doing following some certain basic metrics, then I think you're flying blind in terms of understanding your trading engine. And those would be average R for winners and average R for losers, because that average R multiple has to be bigger for winners than losers, unless you have a 90% batting average, right? Which I would argue that very, 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 I don't want to say nobody, because somebody will come on here and be like, look at this, and here's my audited trading returns. I have a 90% batting average, right? And somebody I'm sure does, right? But most human beings that are traders, 50%, 60%, right? So you have to have that average R bigger on the winners than on your average loser. And if you're not paying attention to that, you're simply not understanding what you're doing. You're not and that leads to expectancy, which is percent winners and percent losers using that average R, that average gain. And it needs to be positive, right? That the average winner needs to be above the average loser. But I'm not tracking like past 20 days or anything like that. I certainly look at my journal to see, I first of all key on trailing 12 months. Actually, I think year to date is useless until it's December 31st. Then it makes sense. But I look at trailing 12 months, and I will try to see where have I had spots where things haven't been working, and then I honestly will try to correlate it to an index chart and see, was I pushing it here in a crappy environment, or what was I doing, right? And I'll dig into that. So that's one way I relate the journaling back to this, is I will, if I see historically a tough period, was I doing something here, or was I pushing in a crappy environment? And I'll look back on that. But honestly, I think in terms of journaling, average R winners, average R losers is like the absolute thing you have to do. And I will, then filter it with swing and position trades, of course, because I want to see which type of style is performing better or worse. You can obviously put 6 million bells and whistles on it, but if you don't have those, you are flying blind in terms of understanding your trading engine.
Yeah, excellent. I think that's a great framework for people to get started with. There's a good question. Let me find it here. Yeah, it's from Juan Ramirez. What do you have to see to bail out on a trade, and maybe to take it a little bit, a step further? How in general do you like to keep losses small? What tactics do you employ to make sure a loser isn't going to get out of control?
So I think that is going back to what I was talking about, which was one of the frequent questions that I get, which is, I'm interpreting how do you bail out on a trade, meaning cut a loser short. That's how I'm interpreting it, because otherwise it will simply hit my stop and I'm out. I do not trade in a world where I don't play stops, right? One of my mantras is never, ever, never, ever, never, ever, not ever cancel a stop. And then on Twitter, somebody will be like, but what if? No, not ever, never, never. So there's never a world where I need to, I guess, bail out. So I'm interpreting that as cutting it early. And that goes back to exactly what I was saying, which is the decision is made beforehand. So what I need to see is the trade moving against me. It's as simple as that. The trade is moving against me and my strategy is defensive in nature. And what I'm going to do is keep my losses very tight. All I need to do is see it move against me and I'll cut it. And then for me, it's around 0.2, 0.3 R. So when it starts to get a third of the way down to my stop loss, I'm done. And that's very defensive, right? That is very defensive. That will absolutely lower your batting average, and you will take more of those smaller hits, but it will keep my losses from hitting the 1R level. So if I have, in 2022, this is exactly how I was profitable, was by doing that. And I also went short a decent amount of the time, which worked in 2022. But it was being very defensive like this. So the decision is made beforehand. I'm not looking for anything other than price to reverse on me, and then I'm out. And like I said, if I take 3 or 4 of those in a row, I'm done. And that would equal 1 stop out at 1R, right? So this is a way to keep it all, keep the math in gear and cut my losers short. And people sometimes ask me, so then why don't you just size the trade so that your stop is much closer? Because then the answer is you're going to take that full 1R many, many, many times, right? So I'm sizing the trade to a normal stop level, but I'm cutting it if it doesn't behave the way I want it to very quickly. And it's certainly not a style I like trading, but it has improved that trading engine math for me through 2022. And now I'm honestly looking to get out of that gradually.
Yeah, excellent. There's a question, let me find it here, from Kip. Considering the stock market environment analysis, does Matt also take into account the economic environment, and how much does that impact how he trades? I might know the answer to this, but I think it's a good thing to bring up.
It doesn't. I mean, look, I'm not going to pretend like I don't know. I'm not seeing what's going on out there. I mean, as like an informed human being, I have an opinion like everybody else does. But that opinion I keep in a separate compartment in my brain, right? I'm reacting to price. And frequently, this is something that I say frequently too. Frequently, if you are a price action trader, you are going to take trades that go against that inner Nostradamus voice that you have. Why were home builders suddenly running a couple? Well, what the hell was that about? But if you're a price action trader, you're following it. You're not arguing with it and saying, well, right, but obviously the real estate industry is going to collapse and all this. So the answer is it's noise. It's noise for me. I'm not a macro guy. Intellectually, if you want to sit there and deal with it, I think it can be intellectually stimulating to talk in macro world, but that's not how I trade. That is not my signal whatsoever. I'm a price action trader.
Yeah, excellent. And I think this is an interesting question here from Joey, and it's kind of having to do with individual setups. Do you scientifically, in quotes, measure performance of individual setups, both taken and passed on, to track environment, or is it just a general feel/observation of your watch list?
So meaning, do I come up with like some sort of rigorous back testing and have like percentages like 38% of descending wedges failed or anything like that? No, I do not.
I think it might be more in real time. So, you notice downward trend line breaks working. So you keep track of that versus another type of setup. Like,
yes. Absolutely. So that's one way to adapt, right? Within the same strategy, because for me, I'm not a one setup trader. I know some people are. But I have multiple setups that I'll use. And in certain environments, you're going to go to different setups, right? I mean, I think we would all plainly agree that since basically February of 2021, those basic base horizontal pivot trades are not getting results, right? That Google was like, a rarity right there, right? So yes, I will move towards much more towards the like downtrend line setups and things like that, 100%. But it's all still within like the lexicon of my style. It's not like I have to suddenly do this thing I've really never done before to adjust. I mean, I will just start taking more pullback plays if those start working better. I think everybody does that to a certain extent, unless you are literally a one setup trader, in which case you've got one option and you better really listen to the feedback of that. But I think that's part of the adapting. I didn't enumerate that actually in the slide, so that's a good point to bring up as part of adapting to this.
Yeah, I think that's something I've noticed more and more. There's kind of a technical theme that happens sometimes where a lot of the similar setups work together. A few weeks ago and maybe a month or so ago, those earning gaps were just going, and that was opportunity for people who like to trade those. So that's something I keep an eye on as well. So and Joey clarified, yes, like real-time performance of setups you're monitoring. Yeah, awesome. Yeah, perfect. Let's see, from Scott, this is a good question. Since you mentioned that you will be very defensive and get stopped out quite a bit, would you please walk through your process for re-entering a trade after you have been stopped out?
Yeah, if it sets up again, I'll get in it. If I've taken a small loss, I have no problem getting in it. That's another reason why cutting it short actually helps, because if you take 3 1R losses in a trade, I mean, you're digging yourself a hole, right? So if I take some really quick, small paper cut losses, I'm happy to get right back into a trade. I have no problem doing that. And I think that that's something that, a lot of people that, I hate to say that a lot of people that are new struggle with. But I think that there are a lot of people that are new that struggle with it. Like it's either going to work or it's not, in their mind, right? Especially if you really want to try to have like an algorithmic response to everything. You're thinking in black and white, and sometimes it takes 2 or 3 tries to get into a stock, and sometimes you're just not going to get in. Right. So, but I have no problem especially if I know I'm already employing this kind of hyper defensive tactic that's going to choke a trade off. I have no problem getting back in if it sets up again and is in the same spot that, I wanted to take it in the first place, as long as the setup has not changed. So, I think the answer here is just that I'm happy to revisit a proper asymmetric risk reward setup, as long as I've taken a small loss along the way. If I'm taking 2 or 3 1R losses, something's not working right there, right? So I think I'm actually more apt to re-enter a trade more when I have this defensive tactic going on.
Yeah, and I saw a few questions about your BPS terminology and how that compares to a percentage of equity. So maybe you could kind of clarify for that, how that translates.
Sure, it's silly talk, right? But it comes from the world of
we love our acronyms.
Right. It comes from the world of like Fed rate hikes and things like that. I mean, Usually when you're talking about interest rate hikes, you're talking about in basis points, right? So 100 basis points is 1%, really. It's just as simple as that. 25 basis points is 0.25%. So if I say I'm taking a 100 basis point trade, it means I'm risking 1% of my total account value. So it's just silly talk, honestly, but it's something that I've just gotten very used to, but it is just a percentage, a way of expressing percentages.
Yeah, excellent. And a question I want to ask, just because I think it's an interesting topic. Do you typically set your stops based on a technical level, or just kind of a standard, percentage drop from your entry point?
Yeah, I am definitely the technical level guy. So I do not do those flat like 7% stops or 8% stops. I want there to be a reason there. Mm-hmm. And like I said, I am super visual. I'm chart oriented. And if I'm taking a trade for a reason, right? It's that asymmetric risk reward. And there's a point where I'm wrong. Or at least there's a point where the setup that I'm trying to take is invalidated. It's wrong, right? I was wrong either today in terms of timing, or just wrong in general. And that's where I want to be out. So usually it's like a day's low, previous day's low, sometimes moving average, key pivot level, et cetera. But it's definitely a technical reason. But usually, especially when I'm swing trading, I will try to keep them tight. So I'm trying to find really tight ways to enter, because I think that's the best risk reward opportunity, right? So if I'm finding a trade that aligns with a technical level, and that I can place a stop within 2 to 4%, and that's definitely my sweet spot. And I saw you tweeted something that Ross Haber has nailed into you about something similar to that, where it's not a setup if you don't have this tight kind of risk reward. I definitely resonate with that. I mean, that is definitely the way I operate. So technical level, but I am always looking for that technical level to line up with a pretty tight stop based on entry and stop.
Yeah, the way he phrases it is he wants it to be tight and logical. So it's not
perfect.
It's not just that you have a stop within a few percent. It has to make sense for the setup in play. And if you're not able to align both those things, both tight and logical, it's likely not a setup, right?
So yes, yeah. I love that. That, because you don't just sit there and say, "Oh, I'm going to put a stop at 2%." That's, to me, that's as useless as saying I'm going to put a stop at 8%, right? It has to actually line up at the technical level, but I want to see it get pretty tight. So yes, I love the way he says that.
And I'm sure a few people will be wondering this. Do you set your stop, right at that level, just below? And how do you deal with those algos who stop you out all the time?
See, I'm not a person that believes that like anybody's paying attention to what the hell I'm doing, even computers. I'm not running $60 billion. I mean, I would challenge somebody to figure out what I'm doing and like see what my order flow is. But I'm not somebody that subscribes to that. I'm putting stops at a technical level, and if they get taken out, they get taken out. And that's the way it goes. I'm not trying to outsmart myself with stops.
Yeah, perfect. And just a few more questions here. I wanted to ask this one. How quickly will you move your stop to break even to protect your entry point? You may have touched on that already, but it'd be good to go over it again, I think.
Yeah. So in defensive posture, if I'm making progress, even if I don't, my usual standard is I'll take a first partial at 1 to 1.5 R, and at that point I'll move my stop up. There can be exceptions to that, obviously, because the market doesn't care where the hell your break-even level is, and it's not always going to align with a good technical level. So in a when I'm not being defensive, I will give it a little bit more breathing room. But generally, on that first partial, when I take a partial at 1 to 1.5 R, more towards the 1.5 R range, in the defensive posture, I don't care that I'm going to get chopped out. I'm not taking a loss. Like, so once I start making progress, even if I'm up to 0.7 R, 0.8 R, stop goes to break even. If you want to cut me out, fine. I'll re-enter if I want to re-enter. But the idea is to not take a lot of losses and keep them very small. And then so people will say, especially if you're cutting losses short, they'll say, well, then you're taking 100 small losses. The thing is, I'm not, because if I have that rule where if I take a few in a row, I'm taking a break, right? So I'm never going to get to the point where I'm taking like 30 small losses in a row, because I'm just going to chill out.
Yeah, excellent. I think that'll be helpful for people. There's a few questions in response to how you set stops, asking if you take ATR into account at all, since sometimes stock will have a 1 ATR of higher than 50 BPS, where just normal fluctuations might stop you up.
Right. So I usually do not. What I'm trying to do, honestly, especially actually, it's weird, because when you get to the extremes of trying to be aggressive and the extremes of trying to be defensive, they start to actually mirror each other a little bit. Because what I'm actually looking for in those moments is the stock to just move. I want it to just move, and I want to catch that. Right. And if that doesn't happen, then it's just, I consider it not happening. Right. But those are kind of like the extreme levels. So no, I don't use ATR, because frequently, if you use ATR with very volatile stocks, your stop is going to be extremely wide. And that's not what I'm doing. So if I'm playing like something like AI, for instance, which I have not participated in ever since it made one of these 33% up, 33% down moves in consecutive days. But like, you're never going to be able to do that. You're never going to be able to participate in a stock like that if you're doing that. I mean, that's an extreme example. But what I'm trying to find is these inflection points where, the stock is going to move. It's just going to move, and the best trades I think most traders would agree that the best trades they ever have are the ones that just move right out of the gate. So when I'm being particularly defensive or particularly aggressive, that's actually what I'm looking for. And if it doesn't, I want to be out. Right. And then under, let's call them more average circumstances, I will have a wider stop, but it's not based on ATR. It's always based on a technical level.
Yeah, perfect. Let's see if there are any other questions coming in. Let's see, we'll just take one more, I think. All right, so this is a pretty good one here. How have your trading metrics you have tracked changed over time? Have you simplified and reduced drastically over the years? So I think similar to your indicator, maybe the journaling metrics is what he's referring to.
Yeah. So I mean, I'll do like the performance of them, or
I think just the number of metrics and complexity.
Gotcha. Yeah. So yeah, simplified. So I do use trading software. I used Excel for, I don't know, 20 years, and I'm getting away from it. And I have this pretty robust Excel journal built out, and I still do. But what I liked about that was I would track partials. So I'm tracking the partials and seeing where I'm taking partials and things like that. But I have really simplified it to just what I was saying. Like at the top of my trading journal is just that average R for winners, average R for losers. And I know very quickly if that's trending in the wrong direction or not. And that is the entire bottom line of my business, So that's really what I focus on. But I do find it helpful to filter based on different ways that you're trading. I mean, the position trading versus swing trading, I definitely filter on that, because those are two different ways of trading. And I absolutely filter option trading versus equity trading, because those are two very different ways of trading. So I want to key on those differences in terms of being able to filter through them. But other than that, it's really basic. I don't use all the bells and whistles of some of the trading software programs. They're awesome, but I definitely don't use all of that, especially the ones that actually forecast. I don't think I'm even on board with that necessarily. But my point is, I think my answer is that just about everything I do with trading becomes really simple. And there's a difference between simple and simplistic, right? Simplistic means you're ignoring the complexity of the issue and making something just overly simple. But simple, I'm trying to capture what I really think is important with some simple things.
Yeah, perfect. And one last question having to do with stops. Do you typically set them using daily levels, or do you sometimes go intraday just to keep it a little bit tighter? What do you like to do?
I will do intraday levels, but I'm also, it's like if you've got a candlestick I use candlesticks. It's like if you were thinking of entering on the day's low, but that day's low is a wick, maybe I'll enter before the body of that candle,
Right.
So things like that. So I'm not digging into like a 5-minute chart necessarily, but I'm looking at ways to enter a candle. For instance, like if there's a big high range candle or something like that. Well, I usually wouldn't enter in a high range candle, but if there's a candle that's like all body and no wick, I might decide, hey, if this reverses back through that candle halfway, I'm out. So I'll put a stop halfway through that candle. So it's not really going into a 5-minute chart, but it's using that daily candle and thinking of ways to kind of parse it, if that makes sense.
Yeah, 100%. Yeah, perfect. Matt, this has been really great. I think it's helped a lot of people watching clarify some parts of their system. Thank you very much for taking the time. Where can people learn more from you? And do you have any other recommended resources or any last words for people watching?
To learn more about me, these things up here on this last slide on Twitter, I'm on at the Equilibrium. So I'm usually spouting off about risk management and things like that on there. Also, I did an interview with you that a lot of people have watched. So on your website, if you want to hear more about that, there's an interview with me on Richard's YouTube website. And you can check out my site, which is Trading Equilibrium. That says a little bit more about me, but it is also where my service and course live. And those are ways to learn more about me as well.
Yeah, fantastic. Well, Matt, thanks again so much for taking the time for putting this together. I think it'll help a lot of people. To everybody watching, I hope you enjoyed it. Please go ahead and leave a like down below if you're enjoying the conference and stream so far. We would really appreciate it. And of course, subscribe if you haven't yet, and definitely go ahead and check out Matt's links right there.